Welcome to the Daily Consolidation, your 15-minute briefing on today's market action. Please note that the views shared here are not personalized financial advice and are for informational purposes only. Always consult with a financial professional before making any investment decisions. Now let's dive in. So today, November 19th, U.S. equities finally managed to break a pretty demoralizing 4-day losing streak with a modest recovery. The real question, I think, is, was this a real rally? Or just, a dead cat bounce amid all this policy confusion?
Temporary reprieve feels like the right phrase. I mean, yes, you saw the S&P climb 0.38%. The Nasdaq did a little better, up 0.59%.
But the Dow was basically flat.
Barely breathing, up just 0.1%. But, the real tell is the VIX, the volatility index. It closed way up there, 24.69. A VIX at that level tells you the market is not celebrating. It's bracing for something.
And that something is all about the Fed in December. I think the most shocking number we've seen is the absolute collapse in the probability of a rate cut.
It's stunning. I mean, just think, a month ago, the market was pricing in a 96% chance of a December cut. It was a done deal.
A certainty.
A certainty. Today, that probability has cratered to around 46%. So in 30 days, you've gone from a guarantee to basically the coin toss. That reversal is what's driving all this anxiety.
Okay, so let's get into that, because it all stems from those October FOMC minutes that just came out. And reading them, it doesn't sound like a unified central bank at all. It sounds like they're having a full-blown identity crisis.
That is the perfect way to put it. And you have to read the language here so carefully, because in Fed speak, little words mean a lot.
Several versus many.
Exactly. The minutes said several participants thought more rate cuts could be appropriate in December. That's your dovish camp. But then it says many participants suggested keeping rates right where they are for the rest of 2025.
And in the language of the Fed, many is a much bigger group than several.
It's a clear signal. The committee is tilting hawkish, tilting towards that higher for longer stance, no matter what Wall Street wants to hear.
And this whole internal fight is happening in a vacuum, which makes it worse.
It's happening in a policy limbo. You've got inflation that's just stuck at 3%. They've been chasing that 2% target for almost 5 years. And, maybe more importantly, they have no reliable jobs data.
Because of the 43-day government shutdown, can you just quickly break down how that actually works? How does a shutdown blind the Fed?
It just turns off the lights. I mean, key reports like non-farm payrolls, JOLTs, a lot of the inputs for the CPI, they all rely on federal agencies to collect and process the numbers. When that stops for 43 days, you're missing 2 full months of data.
So they literally don't know if the labor market is strong or if it's cracking under the surface.
Exactly. And you can't build consensus on policy when you're flying blind.
Okay, so no data, no consensus, recipe for volatility. And we saw that play out immediately in the U.S. dollar, which just had a monster day.
A really decisive move.
Yeah.
The dollar index, the DXY, shot up 0.68%, but the big deal is that it broke cleanly above 100, closing at 100.23.
Which is a huge psychological level.
First time it's held that level since early November. This is a real reassessment by the market.
And is this just a simple yield play? The Fed looks like the only game in town?
I think so. It's a relative trade. Fed, even if they're divided, still looks more hawkish than, say, the ECB, which is holding at 2.0%, or the Bank of England. So if the U.S. is the only place your rates might not fall,
that's where the money goes. It's the best house in a bad neighborhood.
Exactly.
And the ripples from that are immediate. A strong dollar makes dollar-denominated stuff more expensive, and crude oil got hit hard.
It really did. Crude plunged 2.09%. Now, there's some fundamental supply issues we can get to, but that dollar strength was like pouring gasoline on the fire.
Okay, but then here's the paradox. Gold. Gold should get crushed by a strong dollar, but it actually went up. It rose 0.44% to over $4,000. How do you square that?
That is a pure, clean signal of fear. Normally they're inversely correlated. When one goes up, the other goes down.
Right.
The fact that gold is rising in spite of a ripping dollar tells you investors are so worried about policy uncertainty and, frankly, Fed confusion that they're buying a safe haven regardless of the currency headwind.
Okay, let's pivot back to equities then. This little rally today. Was there anything technically significant about it? Did the S&P reclaim any important levels?
Not at all. And this is key. The S&P 500 failed to get back above its 50-day moving average, which is sitting right around 6,660.
And that's a big line in the sand for traders.
A huge one. And breaking below it earlier this week ended this incredible 138-session streak where it stayed above that level. Failing to get back over it today confirms that the short-term trend is, officially broken.
And the weakness is even clearer when you look at the breadth.
Oh, it's terrible.
Yeah.
Only 41% of S&P 500 stocks are trading above their own 50-day moving averages. That's an incredibly narrow reading. It tells you this isn't a broad-based rally. It's just a few big names holding things up.
A totally bifurcated market.
Completely. And you see it in the individual movers. On one hand, you have Alphabet up 3%, new all-time highs. Everyone's excited about the Gemini 3 AI rollout.
And Lowe's had a great day.
Lowe's up 4% after a solid earnings beat. And their story is interesting. It's all about their focus on pro customers, the contractors, who are much less sensitive to the pressures hitting the average consumer.
Which is the exact opposite of the story at Target.
The exact opposite. Target fell hard. Comparable sales down for the third quarter in a row. They had to slash their guidance for the full year. And even big tech wasn't immune. You saw Meta and Microsoft under some serious selling pressure.
Which brings us to the main event after the bell, NVIDIA's earnings.
And it was a blockbuster. Just a massive beat. Revenue of $57 billion when the street expected $54.9 billion. Jensen Huang, the CEO, said Blackwell chip sales are off the charts.
A huge number, no doubt about it. But the interesting part to me analytically is why did that kind of blowout report feel so necessary?
That's the perfect question. Because a year ago, just meeting expectations would have sent that stock flying on pure hype.
Right, the AI at any cost mentality.
Exactly. But that sentiment has shifted. NVIDIA is trading at these incredibly high multiples, which means a ton of future growth is already priced in. The fact that they needed such a massive beat just to keep investors happy? It tells you the bar has been raised. Investors now need to see hard proof that all the money being spent on AI is turning into actual profitable revenue right now.
Okay, let's jump over to commodities, because we saw that same kind of bifurcation in the energy complex today. Two totally different stories.
A complete split narrative. First, you have crude oil, down over 2% to $59.47. That's driven by real oversupply concerns. You just got the third straight weekly build in U.S. inventories.
Another one.
4.4 million barrels this time. And you have major analysts, Goldman Sachs included, now forecasting a global oil surplus by 2026. That's a very bearish signal.
But then right next door, you've got natural gas, and it's practically a crisis.
It's on fire. Natural gas surged 4.17% today to $4.55 per MMBtu.
And for anyone who doesn't follow that, an MMBtu is just the standard unit for gas trading.
Right. And this move today is part of a wild run. The price is up 34% in the last month alone.
Wait, 34% in 1 month? That's almost crypto-level volatility in a fossil fuel. How can anyone even plan for that?
You really can't. And it's driven by a real supply-demand squeeze. We're exporting record amounts of LNG, which drains our domestic supply, and you have forecasts for a really cold winter coming.
So the aggregate commodity numbers are hiding these huge, sharp cost pressures underneath.
Wildly different stories.
Yeah.
And we have to connect all this uncertainty back to the bond market, specifically credit, because what's happening there is a big warning sign.
Okay, what are you seeing?
A massive repricing of risk. Investment-grade corporate spreads, that's the extra yield.
Yeah.
Investors demand to hold a corporate bond instead of a risk-free treasury.
Right.
They've widened 60% in just 3 weeks. They've gone from about 75 basis points to 120.
And 120 basis points is a 1.2% premium. That's a huge move in a short time. So why should an equity investor care about corporate bond spreads?
You should care, because the bond market is often the canary in the coal mine for stocks. When spreads widen like this, it means it's getting more expensive for companies to borrow money. That higher cost of capital directly squeezes things that shareholders love, like stock buybacks and dividend hikes. Credit investors are basically seeing the economic weakness before it shows up in earnings reports.
Got it. Let's switch gears to crypto, where it seems like there's a big psychological battle playing out around Bitcoin.
Yeah, the whole world is watching the $90,000 level. Bitcoin is just hovering there after dipping below it earlier this week. It's really become this make-or-break point for the entire bull market narrative.
And what's driving the selling pressure? It seems to be coming from the big money.
It is. It's sustained institutional outflows from the U.S. spot Bitcoin ETFs. We're talking about $2.5 billion out in November alone. And the ironic thing is BlackRock's fund, IBIT, which was supposed to be the symbol of Wall Street's acceptance. It saw its largest single-day outflow since it launched. When the so-called smart money starts heading for the exits like that, it sends a really powerful negative signal.
So if $90,000 does break for good, where do we look next?
The next major support zone would be down in that $80,000 to $85,000 range. And part of this is also regulatory frustration. The SEC is dragging its feet on some rules for institutional custody, and that's just slowing down new money from coming in and making existing holders nervous.
And just quickly, before we look ahead, what's happening in real estate?
Things are definitely normalizing. The median home price is around $439,000, which is only up 1.2% year over year. But the interesting stat is that over half, 53% of U.S. homes are actually down in value from their peak. And mortgage rates are still high, around 6.15% for a 30-year fixed.
Which keeps people from moving.
Exactly. It creates this lock-in effect. Nobody wants to give up their 3% mortgage for a 6% one, so turnover is at a 30-year low. And that's a real drag on the broader economy.
Okay, so looking to tomorrow and the rest of the week, what's the one thing everyone is waiting for?
It's all about the data. Specifically, tomorrow's delayed September jobs report. Remember, the Fed's been flying blind without this for 2 months. This is the first real look we'll get at the health of the labor market, and it is going to heavily influence what everyone thinks will happen in December.
So if you put it all together, the divided Fed, the strong dollar, the weak technicals and stocks, the credit market warnings, what's the base case for how the market trades from here?
I think the base case has to be just consolidation and chop. We're giving that about a 40% probability. Markets are just stuck in these ranges. The VIX stays elevated, and everyone is waiting for some clarity from the Fed. And, if the central bank itself can't agree on what to do, you can't expect the market to find any real direction.
And that kind of brings us to our final thought. With that extreme division we saw in the FOMC minutes, that many versus several debate, you really have to ask yourself, what happens to market certainty when the central bank itself doesn't have any?
It means that the price of risk just went up. The uncertainty itself becomes the baseline. So the question you need to ask is, how does that change the way you think about positioning in long-duration assets right now?
That's all for today's episode of the Daily Consolidation. If you enjoyed our analysis, remember to like this video and subscribe to our channel for more daily market briefings. See you at the next close.